Hi, and welcome back to Tax Talk with Mr. Derek. I'm joined once again by our resident tax expert, certified public accountant, Mr. Michael Stanczak. Welcome.
Thank you very much.
In our last video, which we just finished shooting, you mentioned the foreign earned income exclusion. This is for U.S. taxpayers, U.S. persons.
U.S. taxpayers, sure.
Okay, who are non-U.S. residents.
Yes, you must be living in a foreign country in order to claim the foreign earned income exclusion.
Okay.
And you have to have actually earned the money in the foreign country as well.
Okay. Now, there are several criteria that have to be met to prove that you are
Well, let me get into it. There are two tests.
Okay.
Two possible tests. You don't need to meet both of them. You just need to meet one or the other.
All right.
The first test, which is the easiest, is the bona fide residence test.
Okay.
But the problem is you need to be a bona fide resident for the full calendar year. That's from January 1st until December 31st in the year that you're claiming this exclusion.
Okay.
So the first year you come to the foreign country, you probably aren't going to qualify unless you get here on January 1st. And that's a problem for some people. But after you've been here for a while, it's a lot easier to qualify for the bona fide residence test than it is for the second test. And what does it mean to be a bona fide resident? Well, if you're working here and if you're living here, you have a place that you've bought or you're renting, you've registered to pay taxes in the country, you have a driver's license, your spouse is living here, your children are going to school, those are all tests that prove that you're a bona fide resident.
Okay.
So then there are others that you might need, but most of those that I mentioned are the ones that will certainly qualify you for the bona fide residence test.
Okay.
The second test, which is a little more complicated, is the physical presence test. And that is within 365 days, if you are physically present within the foreign country for 330 of those days, then you can claim the foreign earned income exclusion also.
So you're saying like up to about November 26th?
Well, not necessarily. Suppose you came in the middle of the year. You arrived on August 1st, let's say. Okay. Well, you would have been in the country for 5 months working. And in that year that you're filing your taxes, you wouldn't have qualified as a bona fide resident for the full year. And you wouldn't have qualified for the 330 days because you haven't been here for that many days yet. Okay. In that the first year, then you will not be able to take the foreign earned income exclusion. I see. But let's suppose you continue living in the country for another 7 months. The next year, then after you pass June or July, whenever the 330 days are up, it's possible that you would then meet the test for the beginning of the time when you first got here. Okay. And if that is the case that fits you, then you'll need to go back and amend your previous return if you want to claim this exclusion, and then you can not include that income on your U.S. tax return. But it requires you to amend your prior return after you qualify. Okay. Now that's a little confusing for some people, and most people don't like to amend their return, although there's no reason to fear an amended tax return. There is a better way, and that is if you don't qualify and you include this income on your U.S. tax return, but because you're working here, you pay taxes to your foreign country, you can take the foreign tax credit and reduce your U.S. taxes by the taxes you paid, in our case, to Japan, and reduce your U.S. taxes that way without even bothering with either of these tests for the foreign earned income exclusion. Huh. Okay. And for most people in a country where the tax rate is higher than it is in the United States, such as Japan, this is an easier way to do it. You don't need to file an amended tax return, and you still will end up not paying any U.S. taxes. Excellent. I think people will appreciate that kind of news. Okay. All right. There you go. There you have it. There was a kind of an overview of the criteria of the foreign earned income exclusion. Again, Mr. Michael Stanczak. There's one thing I want to point out. Oh, yeah. The amount of the exclusion, by the way, in 2020 is $107,600. Okay. And that amount changes every year because it's indexed to inflation, I suppose, or the cost of living in America. So if your income is greater than $107,600 in 2020, you would not be able to exclude any amount more than that. Okay. But you can still take the foreign tax credit for the portion that is not covered by the Earned Income Exclusion.
The first 107K.
Correct.
Roughly. Okay. All right. Good to know. There you go. An overview of the foreign earned income tax credit.
No. The Foreign Earned Income Exclusion.
There you go.
FEIE, Form 2555.
Oh, again, I said he was the expert. Thank you very much. And tune in for the next episode of Tax Talk.